Imagine a company similar to Amazon, but 10x. They deliver nearly every type of product to millions of Chinese consumers, sometimes within hours. A company that operates like a logistics superhighway built on robotics, AI. So while all the e-commerce companies race for scale all around the world, there's one Chinese tech company that is quietly re-engineering the supply chain advantage that even Amazon is studying. The name? JD.com. They have an AI-powered warehouse, drone deliveries in smaller villages already. They aren't just reinventing online shopping, they're building the future of commerce as we know it. So, JD.com. I can't read any of this, but this is China's leading supply chain of China's biggest retailers. Let's just click some of these buttons. So they currently have 600 million active annual customers with total annual revenues hitting over 170 billion. Headphones, they sell food. This is the Amazon of China, but 10x. Electronics, home appliances, Apple Watches. They got beauty products, they got healthcare. Pop Mart, huh? You can buy some Labubus here. Lego. Is that a car? Looks like you could buy some cars, laptops. Go ahead and check out some of the fundamentals real quick. Latest quarter, quarter 2, 2025, total revenue posting 49.7 billion. 49.7 billion in one quarter, while the company is selling at 55 billion. So the total sales for one quarter that they're making pretty much equals the market cap of the company, and it grew 24% year over year. This is the highest revenue growth rate that JD.com has posted in the recent 3 years, 49 billion. I mean, if you take a look at the past year alone, they're hitting year over year growth in the double-digit ranges. So that's quarterly, but if you take a look at annually, trailing 12-month, $176 billion. For 2024, they made $158 billion in revenue top line. This is where a lot of competition comes in for this company. So they do make a ton of revenue, but the profit margins are super low. So a lot of competition. 9% profit margins? I mean, that's not that great. That kind of shows they don't have a competitive advantage. Pretty much they're operating with price wars. With earnings per share, the latest one, they actually posted negative 46% year over year. And so if we take a look at the latest transcript, they talk about how this is primarily due to the massive losses that they have incurred from their aggressive expansion into food delivery and a lot of capital expenditures this year to expand the business. So not only is JD.com a retailer, they also offer logistics, technology. They have a bunch of AI, big data centers, cloud computing. Let's take a look at. So they're investing a ton into robotics. They invested 600 million in its pre-AI funding round for this company, Spirit AI Robotics. Looks like they are also an investment firm. China's JD.com backs 3 robotics startups in an AI push. They also invested in LimX Dynamics and Engine AI. This company is throwing so much money into robotics. Looks like JD.com invested nearly 1 billion won into Engine AI. Let's take a look at Engine AI. It's a robotics system with a large language model. Our mission is to humanize data, making it accessible to anyone at scale. The future is going to be crazy, guys. Like a lot of this stuff we don't even hear about that's happening in China. I mean, we have Tesla over here leading in robotics, but the amount of money JD.com is spending on robotics is actually insane. They have JD Health, Industrials, JD Property. They're a real estate company. This company is huge. So again, from all that, a lot of capital expenditures were used. I mean, just by looking, let's go ahead and look at the capital expenditures. Yeah, look at all this money they're spending on CapEx. They spend over $2 billion per year on capital expenditures. So that's why we're going to see a lot of the free cash flow down here, cash flow from operations, be negative year over year. They're reinvesting a ton of money into the business. Let's check out FinViz. 1.3 billion shares float. So they do have a lot of shares. Not a lot of insiders own the company. It's not getting shorted. So super low PE ratio, as you could tell. They have a ton of revenue. And the price pretty much matches their market cap. And no insider buying. No insider buying. Institutional ownership is going down. So I don't like this. I don't like when institutional ownership is going down in a company. So hold on. So according to the transcript, they do have a lot of competition. And there are 3 major players that they are competing with. The big one, Alibaba, Pinduoduo. This is another e-commerce company in China. Man, some of the stuff they're doing over there is insane. You also see this one that's all over TikTok. So it looks like it's their social media, but it's connected to TikTok. This is where people buy their stuff directly. This website is fast. A ton of competition for this company. I think that's the reason why a lot of institutions are jumping out. Out of all the competitors, Alibaba's market cap is at 390 billion. Pinduoduo is at 185 billion. Out of the main competitors, JD stock is selling at the cheapest at a $55 billion valuation. It does present a good investment opportunity, Possibly at these levels, when you compare it to the competitors, this does look like a pretty good investment. Again, PE ratio is super low. Fundamentals aren't too bad. I don't like how the profit margins are so low. You don't have a big competitive advantage. Remember, when you go down to the cash flow statements, they're spending a lot of money on growth and capital expenditures, causing it to look bad right here. Lastly, they do also have a fortress balance sheet, $29 billion in cash. $29 billion in cash. Pretty much half the market cap they have sitting in cash. $6 billion in receivables, $14 billion in inventory, $16 billion in net property, plant, and equipment, so $16 billion in real estate, and $15 billion in long-term investments. They're at about $8 billion in long-term debt, so compared to cash, they pretty much have triple the amount of cash compared to the long-term debt, which is a good sign. Let's see if they're paying any interest payments. Interest payments aren't too bad. So annually, they're paying about $400 million in interest payments annually, which isn't bad compared to the amount of cash they hold. So fundamentals look good. The price looks good. The only thing we do need to worry about, again, is intense competition from Alibaba, Pinduoduo. On the latest, though, they are currently pushing food delivery, which they're spending a lot of capex on that. Highest quarterly revenue growth we've seen. Substantial cash position compared to the amount of debt. Lots of real estate they own, lots of receivables, ton of money getting invested into AI and robotics from this company, and the valuation appears super attractive at these levels. So if you're an investor seeking to invest in companies outside the States, diversify, they're going to be fine. So over the next 2 to 3 years, if they could just fix some of the stuff, this company is going to be fine. This company will be fine. Let me know what you guys think about investing in these companies coming out of China, and if you have any other good ones. They are doing some crazy stuff over there. Anyways, thanks for watching this video. We shall see you on the next one. Peace.